All right, Talk Ticker listeners, ready for a deep dive into Polaris Inc.'s Q3 2024 earnings. We've got the presentation, the press release, and yeah, we have got the full transcript of their earnings call.
Oh, wow. The whole thing.
The whole thing.
Huh.
So we are ready to extract some serious insights into how this power sports giant is handling, a pretty shaky market.
Yeah, definitely a lot to unpack there. I think what jumps out at me right away is this move Polaris made with their dealer inventory. It seems like they're intentionally shipping fewer units to kind of combat that, softening retail demand we've been seeing.
Okay, so they're thinking long-term, trying to protect their dealers' profitability by preventing, those overstocked lots.
Exactly.
I think the presentation actually mentioned a 15 to 20% reduction in inventory.
15 to 20%. That's pretty aggressive, right?
It's a bold move for sure, especially when you think about the immediate impact on their sales and their profits. Sales dropped 23% and adjusted EPS took a 73% hit.
Yeah, but here's where things get interesting. This strategy really sets Polaris apart from some of their competitors who are flooding the market with older inventory and slashing prices.
Oh, so it's like a short-term pain for a potential long-term gain situation.
Yeah, you could say that.
They're banking on a healthy dealer network being a major advantage when a market eventually recovers.
Exactly. And that contrasting approach, it raises some fascinating questions about which strategy will ultimately be more successful. Short-term grab for market share or a focus on long-term stability in those dealer relationships.
Yeah, that's a great point. And while they're making these big moves with inventory, they're also quietly becoming like a powerhouse of operational efficiency. I was really impressed by the numbers they shared.
Oh, yeah. They blew past their initial target of $150 million in operational savings.
Really?
Yeah, they achieved almost $280 million.
Wow.
And it's not just about cutting costs. It's about, doing more with less. The presentation highlighted one plant that boosted output by 20% with the same workforce, and another one that saw a 50% reduction in factory rework.
Those are some serious results. It sounds like they're squeezing every ounce of efficiency out of their operation.
They are. And this suggests that Polaris isn't just surviving this downturn, they're using it to come out even stronger.
Yeah, I like that. So they're managing inventory, they're becoming leaner and meaner operationally, but they haven't forgotten about innovation.
Not at all. The launch of the Polaris Expedition is a perfect example. They saw a 25% sales jump for this new off-road vehicle, and that's in a pretty challenging recreational market.
Wow. So they're targeting growth segments and solidifying their position as the innovation leader.
Exactly.
But let's face it, they're not painting a rosy picture for 2025. They're anticipating, those continued market challenges, and they're emphasizing their commitment to maintaining low dealer inventory even if retail demand stays flat.
Yeah, it's a cautious approach, for sure. Makes sense, given the uncertainties in the broader economy.
Definitely. So let's break down their recent performance a bit more. They reported worldwide sales of $1.722 billion for Q3, which is a 23% decrease compared to last year.
Right. And that number, you have to remember, reflects their deliberate decision to lower production and shipments. It's not just a decline in sales, it's a carefully orchestrated move to manage inventory and support those dealers.
Right. They'd rather have a healthy dealer network than a short-lived sales bump. It's a long-term play.
Absolutely. Now, diving a little deeper, North America accounted for the majority of their sales, about 85%. But even that region saw a 26% year-over-year decline.
So it's not just a regional issue. The slowdown's impacting their business both domestically and internationally. What are some of the key factors contributing to this decline?
Well, the lower shipment volume obviously plays a big role, but it's not the whole story. We also need to consider the shift in their product mix towards less profitable items.
Okay.
And the pressure on pricing due to all the promotional activity we're seeing across the industry.
Weight increased promotions. So while Polaris is holding back on shipments and trying to maintain pricing discipline, their competitors are going in the opposite direction.
You got it. Some companies are flooding the market with older inventory and offering huge discounts to clear out their lots.
Classic case of short-term tactics versus long-term strategy.
For sure.
And Polaris seems to be sticking to their commitment to a more sustainable approach.
Exactly. Now let's look at their earnings. Their adjusted diluted earnings per share for Q3 came in at $0.73.
Yikes. That's a 73% decrease compared to the same period last year. Clearly, their strategy is impacting their bottom line.
It is. But it's important to remember the context. They're taking a hit now because they believe it's the right move for the long-term health of their business.
Makes sense. So they're facing some serious sales and earnings pressure What about their profitability? What can you tell us about their gross profit margin?
Well, their adjusted gross profit margin for Q3 was 20.8%. That's a decrease of 184 basis points compared to Q3 of last year.
Wow, that's a pretty significant drop. What are the main factors there?
It's a few things, actually. The reduced shipment volume plays a role, as does the negative impact of that product mix we discussed earlier.
Right. And we can't forget about the added pressure from competitor promotions.
Absolutely a factor. On top of that, they're facing something called unfavorable plant absorption.
Okay. Unfavorable plant absorption. Now, I know some of our listeners might not be familiar with that term, so can you break it down for us? Imagine you're explaining it to someone who's never even heard of it before.
Sure. So imagine you're making a big pot of soup, right? You only end up eating half of it. The ingredients cost the same, but now your cost per serving has doubled because you're spreading those costs over fewer servings. That's essentially what's happening with Polaris's manufacturing costs. They're producing less, so those fixed costs get spread over a smaller number of units, which drives up the cost per unit, and that impacts their profit margin.
Okay, that's a great analogy. I think that makes it much clearer.
Right.
So essentially, they're facing a bit of a perfect storm when it comes to gross profit margin. Reduced sales volume, an unfavorable product mix, pricing pressure from competitors, and this unfavorable plant absorption.
It's a tough situation, but it's not all doom and gloom. Remember those impressive gains in operational efficiency we talked about?
Oh, right.
They're actually helping to offset some of these headwinds.
That's right. They've blown past their cost savings targets. And they're also doing a good job managing their operating expenses, which helps to mitigate some of the pressure on their bottom line.
Absolutely. It's clear they're actively looking for ways to adapt and become more efficient, even as they stick to their long-term strategy. Now let's take a closer look at how their different business segments are performing in this environment.
Sounds good. Let's start with their bread and butter, the off-road segment. So we're talking about their popular ATVs and side-by-sides. How are those holding up in this market?
Well, sales in this segment were down 24% compared to the same period last year.
Okay, so they're definitely feeling the pinch.
They are, and again, lower volume and an unfavorable product mix are the main culprits. They're selling a larger proportion of their less profitable models, which impacts their overall revenue.
I see. Even though they're intentionally reducing shipments, are they seeing any particular headwinds in terms of consumer demand for specific off-road vehicles?
That's a good question. Their North American retail sales for ORVs were down 3% in Q3. And it seems consumers are showing a preference for practical utility vehicles over recreational ones.
Makes sense given the economic climate. People are looking for more bang for their buck.
Exactly. Their utility vehicles, like the Ranger, saw a slight decline, while their recreational vehicles, like the RZR, experienced a more significant dip. But you know what's doing surprisingly well? The crossover category vehicles that blend features of both utility and recreation.
Interesting. So there's still a desire for adventure, but people want vehicles that can do it all.
Precisely. The Polaris Expedition is a prime example of this trend, and it's performing very well.
So it's not just about Polaris managing inventory. It's also about consumers becoming more discerning in their choices. But how much of the decline in this segment is due to Polaris's strategic decisions versus external factors like the economy and competitor actions?
Well, Polaris attributes some of the sales decline to actions taken by their competitors to address their own inventory challenges.
You mean those aggressive promotions and deep discounts we talked about earlier?
Exactly. They believe those tactics are contributing to some short-term share shifts in the market.
So it's not necessarily that consumer preferences are shifting away from Polaris. It's more about the competitive landscape becoming more intense.
Yeah, it's a race to the bottom on pricing, and Polaris is choosing to stay above the fray.
Interesting. All right, so off-road is facing some headwinds. What about their on-road segment? This is where their iconic Indian motorcycles live, right? How are those performing?
Indy motorcycles are feeling the pressure as well. Their sales for the quarter were down 13%, reflecting a broader slowdown in the motorcycle industry, particularly in North America.
So it's not just a Polaris issue. The entire motorcycle market is facing a tough time.
That's right. Big-ticket discretionary purchases like motorcycles are often the first to get hit when the economy weakens.
Are they seeing any particular weakness in certain types of motorcycles?
They've mentioned some softness in the heavyweight category, which has seen some recent competitive launches. However, they're holding on to their leading share position in the mid-size segment, which is encouraging.
Okay, so they're facing headwinds in heavyweight, but holding their own in mid-size. What about their gross profit margin in this segment?
Well, unfortunately, their on-road gross profit margin took a dip in Q3 as well.
Not surprising given the overall trends we've been discussing.
Right. It's primarily due to an unfavorable product mix. And you guessed it, that plant absorption issue we talked about earlier. The higher proportion of lower margin heavyweight bikes they're selling is putting a dent in their profitability.
But on a more positive note, they're expecting a bit of a boost to their on-road gross profit margin in the fourth quarter, right?
Yes, they're anticipating a positive impact from a one-time warranty expense they incurred in their European business last year. Since that expense won't repeat this year, it will provide a bit of a tailwind to their profitability in Q4.
Okay, so a potential glimmer of good news on the horizon for their on-road segment, at least in terms of profitability. Now let's move on to their marine segment. This is where they've been facing some particularly rough waters, right?
You could say that sales were down a significant 36% in Q3.
Wow, 36%. That's a massive drop. What's driving that decline?
Well, the marine industry in general is battling excess inventory, and the impact of higher interest rates on consumer purchasing decisions is definitely a factor here. People are hesitant to finance a big purchase like a boat when rates are high.
So they're dealing with both industry-wide challenges and the impact of their own decision to reduce shipments. It's a double whammy for their marine business.
Exactly. And unsurprisingly, their gross profit margin in this segment also took a hit due to lower sales volume and, yep, unfavorable plant absorption.
Okay, so marine is facing some real challenges, but they did mention some positive feedback from their recent dealer meetings, right?
They did. They showcased some innovative new products at those meetings, and they're already seeing strong orders for those boats, particularly from their Bennington, Godfrey, and Hurricane brands.
So the potential silver lining for their marine business, they just need the market conditions to improve a bit.
Exactly. Once that excess inventory is cleared out and interest rates start to come down, they'll be well positioned to capitalize on the demand for their new products. They've also been very aggressive in reducing their own inventory levels in this segment, which shows they're not just waiting for the market to turn around, they're taking proactive steps to prepare for a rebound.
Well, that's what I like to hear. It shows they're thinking ahead. All right, so we've got a pretty good overview of their segment performance. They're facing challenges in off-road, on-road, and marine, but they're also taking steps to adapt and improve.
Indeed. And they're emphasizing their commitment to operational efficiency and innovation, which they believe will be key to navigating this turbulent market.
They're not just weathering the storm, they're actively preparing for the future. But speaking of the future, they've been pretty cautious about their outlook for 2025, haven't they?
They have. They're definitely not sugarcoating things. Let's delve into their expectations for the coming year. So I'm sure you're wondering what Polaris sees, for 2025. Well, they're not expecting a miracle turnaround.
Yeah.
In fact, they're kind of bracing themselves for continued challenges, in the retail environment.
Right. And that's not really a surprise. The economic outlook is still a bit uncertain, and those interest rates are still, weighing on big purchases.
Exactly. And while that recent Fed rate cut is a step in the right direction, Polaris thinks it's going to take more than just one cut to really get demand going again.
Yeah, one cut isn't going to magically fix everything.
Yeah.
So no sudden rebound expected, even with rates easing a bit. Makes sense, considering how cautious everyone seems to be right now.
Yeah, consumers are still dealing with, high debt levels and inflation's easing, but it's still a concern. And that definitely impacts their spending on things they don't absolutely need, especially, things they usually need financing.
It's like everyone's holding their breath, waiting to see what happens before making those big decisions.
Exactly. And Polaris is responding to that by prioritizing a healthy dealer network over pushing for sales growth in this, unstable market. They're actually projecting that dealer inventory will be historically low going into 2025.
Wow. So they're really sticking to that strategy, even if it means a slower recovery. It's a bold move, but it could be a really smart one in the long run. Think about it. A strong, well-stocked dealer network with the latest models. That's a huge advantage when the market does finally rebound.
I agree. It also builds trust and loyalty with their dealers, ensures they're in a good position to capitalize on that eventual upturn.
It's like Polaris is playing chess, sacrificing some short-term gains for a stronger position down the line.
Exactly. And it's not just inventory management. They're also still putting money into innovation to stay ahead of the curve.
Right. We've seen some exciting new launches this year, like the Expedition, and they've hinted at more to come in 2025.
That constant push for innovation is what keeps Polaris at the top of the power sports industry. It's what makes them different.
They're not letting the economy hold back their creativity or their ambition, But what about the investors? What are analysts saying about all of this?
Well, Polaris knows that analysts and investors are already working on their 2025 models, and they've tried to give them some guidance, consciously. They've emphasized that it's unlikely all the problems they're facing will just disappear next year.
Right. No quick fix.
Yeah, they're urging everyone to be realistic and measured when forecasting.
So managing expectations and making it clear that a full recovery takes time. And it depends on things they can't control, like interest rates and how confident consumers are feeling.
Exactly. They haven't given very specific financial projections for 2025, though.
They've been pretty quiet about that, haven't they?
Yeah, understandable given the current climate. There are still too many unknowns to give precise forecasts.
But they did give us a little something to work with. They mentioned flat could be a good starting point when thinking about earnings.
Right, and that's probably based on the idea that retail sales will stay pretty much the same as 2024. They're not expecting a sudden jump in demand.
So cautious, but realistic. They're preparing for a continued tough environment, but also acknowledging that things could improve, especially if interest rates keep going down.
It's a balancing act between caution and optimism. They're not making big promises, but they believe that focusing on operational excellence and innovation will lead to success.
I like that attitude. Okay, so we've talked about their overall outlook for 2025.
Yeah.
Cautious, but hopeful. Now let's move on to those impressive cost savings they've made this year.
Yeah, their focus on efficiency has been a real bright spot. Initially, they aimed for $150 million in savings.
Right.
But they've gone way beyond that and achieved almost $280 million.
That's amazing. They're really finding ways to make every part of their business more efficient.
Yeah. And it's not just about cuts. They're making real changes to how they operate. Like we mentioned earlier, getting more out of their plants with the same number of workers.
Huge win. They're also reducing waste, streamlining their logistics, negotiating better deals with suppliers. It's a complete effort.
It is, and it's paying off. Those cost savings are helping to balance out the negative impacts of lower sales volumes and pricing pressure.
It's like they're building a stronger, leaner business that can handle any economic conditions.
That's a great way to put it. It's about becoming more flexible and adaptable to handle changes in the market.
So they've achieved these big savings, but are they sustainable? How much of that $280 million is likely to stick around in 2025?
That's a good question. It's a little complicated. Roughly 25% of those savings are directly tied to lower production volumes.
So if production increases in 2025, those savings might go away.
It's possible, but they've said they're not just cutting back. They're finding ways to be more efficient even with higher production.
They're not just stopping, they're redesigning the whole system. It seems like they're pretty confident they can keep a good portion of those efficiency gains even as volumes go up.
That's the plan. And don't forget the other 75% of those cost savings. Those are related to more fundamental improvements in how they operate.
So those are less affected by production volumes and more likely to still be there in 2025 and beyond.
Exactly. They're making big changes to how they do business, changes that will affect their costs for a long time.
So even if sales don't rebound quickly next year, they're setting themselves up for better profitability thanks to those efficiency gains.
Exactly. They're using this downturn to make their business stronger and more competitive, ready for whatever comes next.
It's like making lemonade out of lemons. They're using a difficult time to become even better.
It shows their commitment to constant improvement and their ability to adapt to changing situations.
We've covered a lot here: their finances, their segments, their outlook for 2025, and their cost-cutting measures.
We've seen a company facing challenges head-on, making smart decisions for long-term stability and constantly striving for operational excellence.
They're not just reacting, they're shaping their own future.
Now let's wrap up our deep dive with some final thoughts on what this means for Polaris and for the whole powersports industry.
So where do we go from here? Where does this leave Polaris? It's tough out there, but they seem to be handling it pretty well, focusing on the long-term, building resilience.
Yeah, they're definitely playing the long game, prioritizing a healthy dealer network, even if it means taking some hits to sales and profits in the short term.
It's a risk, but it could really pay off. They're betting that when the market recovers, that strong dealer network will be a huge advantage.
For sure. And while they're doing that, they're also laser focused on operational efficiency. And we've seen how well that's working for them already.
And they're not neglecting innovation either. They're still coming out with new products, pushing the boundaries of what's possible in powersports. So when things turn around, they'll be ready.
It's that combination of strategic thinking, efficiency, and innovation that gives them a real edge. I think they're in a good spot to come out of this downturn even stronger and more adaptable.
They're not just writing it out. They're using it to transform their business.
Yeah.
It's a pretty amazing story of adaptation, I'd say.
Absolutely. And their story reflects some bigger trends we're seeing in the entire power sports industry.
Oh, really? What are some of the key takeaways for the industry as a whole?
Well, it seems like the days of easy growth and huge demand are over, at least for now. Consumers are changing how they buy.
Yeah, the pandemic boom is definitely over. People are being a lot more careful with how they spend their money, especially on big purchases like power sports vehicles.
Exactly. And that means companies in this industry need to change their approach too. What
Yeah.
Polaris is doing with inventory management, efficiency, and innovation could be a model for other companies.
It's like a wake-up call for everyone. The old ways of just making more and selling more might not work anymore.
Right. Companies need to be smarter, more flexible, and focused on giving their customers real value.
It's about building relationships for the long term, not just chasing quick wins.
Exactly. And that's what makes Polaris so interesting. They're not just reacting to the market, they're shaping their future.
Setting themselves up for success, not just for the next quarter, but for years to come.
As we wrap up this deep dive, here's a final thought. Polaris is betting big on their dealer network as a key differentiator. They're investing heavily in their dealers, giving them what they need to succeed even in a tough market. So will it work?
That's the big question. Only time will tell. But Polaris is a company worth keeping an eye on. They're not afraid to take risks. They're all about efficiency, and they're always innovating.
It's been fascinating getting into their story.
Absolutely. Well, folks, that's all for today's deep dive. Keep exploring, keep asking questions, and keep digging deeper.
And remember, a good deep dive can uncover some really valuable insights.
Couldn't agree more. Thanks for joining us on TalkTickers.